Welcome to Earnings Recap. Today we're covering Chevron's earnings report and earnings call January-March 2025. If you enjoy this kind of content, please like the video and subscribe to the channel. Now, these earnings reports, they can be pretty dense, right? So we're diving deep today. We'll summarize Chevron's recent financial performance for you, basically in plain English. We're aiming to pull out the key insights, both from the official numbers and, what the leadership team talked about on the earnings call. Our mission is just to make it clear what's really important about Chevron's first quarter.
Okay, let's jump right in then. Part one, the numbers, the key financials from Chevron's Q1 report.
All right, so the headline earnings number.
Yeah, reported earnings for Q1 2025 were $3.5 billion. That works out to $2 per share diluted.
And how does that compare to last year?
It's down quite a bit, actually. Q1 2024 was $5.5 billion or $2.97 per share.
Okay. And they usually give an adjusted number too, right, to smooth out any one-off things.
Exactly. Adjusted earnings came in at $3.8 billion or 2.19 cents per share.
Still down from last year's adjusted figure then.
Yep. That compares to $5.4 billion or 2.93 per share in Q1 2024.
So what were those special items pulling the numbers around this quarter?
Well, there was a net loss of about $175 million. Part of that was setting aside money for legal stuff, legal reserves, and also a tax charge related to the UK energy profits levy.
Okay.
But that was partly offset because the value of their Hess shares went up. And then foreign currency effects, they also knocked earnings down by about $138 million.
Got it. Okay, let's talk cash flow. Always a big one.
Yeah, definitely. Cash flow from operations was $5.2 billion this quarter.
Down from last year, too.
It was down from $6.8 billion in Q1 2024. And that's mostly, because of the lower earnings we just talked about. Plus, they had some big tax payments related to selling off assets in Canada.
Ah, right. The Canadian sale. I remember that. Does that mean the underlying cash generation was stronger if you ignore those tax payments?
Well, they give a number, excluding working capital changes, which captures things like that tax payment timing, and that number was $7.6 billion.
Okay, $7.6 billion.
Yeah.
How does that compare?
Pretty close to last year's $8.0 billion, actually. So yeah, that working capital swing, largely from those taxes, was a big factor in the headline number. It's an important distinction for you to see.
Okay, that makes sense. Now, shareholder returns, what did they give back?
A lot, actually. They returned $6.9 billion to shareholders in Q1.
Wow. How did that break down?
$3.9 billion was through buying back their own shares, and $3.0 billion was paid out as dividends.
And the dividend itself, any changes?
They declared the quarterly dividend at $1.71 per share. That's payable June 10th.
And didn't they also buy some Hess stock directly, kind of related to the merger they're trying to close?
They did. They picked up just under 5% of Hess common stock. It definitely signals, their confidence in getting that deal done eventually.
Okay, let's shift to production. How much oil and gas are they pumping?
Worldwide net oil equivalent production was pretty much flat. 3.353 million barrels of oil equivalent per day. MBOED.
So basically unchanged from the end of last year and from Q1 last year.
Almost identical, yeah. 3.350 MBOED in Q4 24 and 3.346 in Q1 24. A very stable headline number.
But I imagine there were some moving parts underneath that flat number.
Oh, definitely. The big story was TCO, that's Tengizchevroil in Kazakhstan. Production there jumped 20%.
20%, that's huge.
It is. And they also saw good growth in the Permian Basin, up 12%, and the Gulf of Mexico, up 7%.
So those increases basically canceled out the production they lost from selling assets.
Exactly. That TCO growth in particular is, really significant. It's a sign that big project there is starting to really deliver. It could be a real boost for their international side.
Interesting. Okay, what about spending? Capital expenditure or CapEx?
CapEx was actually a little lower this year, $3.9 billion in Q1 compared to $4.1 billion last year.
And spending by affiliates, like TCO.
That was down too. $0.5 billion versus $0.6 billion, mainly because TCO itself is spending less now that the big project is ramping up.
All right, let's drill down into the segments. Upstream, first exploration and production. How did the U.S. side do?
U.S. upstream earnings were $1.858 billion. That's down from just over $2 billion in Q1 last year.
Interesting. Production was up in the U.S., right? Permian and Gulf. But earnings were down.
Yeah, good catch. The report points to higher operating expenses, including that legal reserve we mentioned, and also lower prices for their oil and other liquids.
Did higher natural gas prices help at all?
They did partially offset things, but not enough to overcome the cost pressures and lower liquids prices.
Okay. And international upstream.
A much sharper drop there. Earnings were $1.9 billion, way down from almost $3.2 billion last year.
Wow. What drove that bigger decline?
It was a few things. They sold less volume, what they call lower liftings. Earnings from affiliates like TCO were lower, partly because depreciation costs went up with the new project starting. Realizations, the prices they got were lower internationally too. And then tax and foreign exchange rates didn't help either.
Any positives internationally?
Well, on the plus side, operating expenses were lower because of those asset sales. And as we said, TCO production itself was higher after the future growth projects started up.
Right. Okay, let's switch to downstream refining and selling products. U.S. first.
U.S. downstream earnings took a hit. Only $103 million compared to $453 million last year.
Ouch. Mainly weaker margins.
Yeah, lower margins on refined products was the big driver, plus that same legal reserve affected the segment too.
Did their refineries run well?
Actually, yes. They processed more crude oil, partly due to better reliability and also the expansion at their Pasadena refinery coming online.
And international downstream.
Also down, $222 million compared to $330 million last year.
Similar reasons.
Wow.
Margins.
Primarily lower refined product margins again, and also less favorable foreign exchange movements. And their international refineries processed a bit less crude because they had a planned maintenance turnaround at their plant in South Korea.
Got it. Lastly, on the numbers, any key ratios that stand out?
Two worth mentioning. Return on capital employed, ROCE, which kind of measures profitability on investment, fell to 8.3% from 12.4% last year.
Not surprising given the lower earnings, I guess.
Right. And their net debt ratio, which looks at leverage, increased. It went up to 14.4% from 8.8% a year ago.
Okay, so summing up the numbers. Earnings definitely down year over year, impacted by market conditions and some specific items, but operationally some strong spots like TCO production, and they're still returning a lot of cash to shareholders.
That's a good summary. But, the numbers only tell part of the story. To really understand their perspective and what they're thinking about the future, we need to look at what management said on the earnings call.
Absolutely. Let's shift gears to part two, the earnings call. What were the key themes and takeaways from management's commentary and the Q&A with analysts?
Well, TCO, that Kazakhstan project, was definitely front and center. Management sounded pretty pleased with how the future growth project ramp-up went.
Yeah, I saw that. They said it hit full capacity really fast.
In just 30 days, yeah. Well ahead of their plan. They put it down to doing a lot of thorough testing beforehand and, using lessons learned from other big projects.
And they talked about the longer-term picture in Kazakhstan, too, didn't they? The concession agreement.
They did. The CEO, Mike Wirth, mentioned he had good talks with the president of Kazakhstan about potentially extending their operating agreement beyond 2033.
So are they going to extend it?
He said there's mutual interest to negotiate, but, these things are complex and will take time. No guarantees yet.
Okay. But near term, TCO should mean more cash coming back to Chevron.
That's the expectation. They specifically mentioned looking for increased cash distributions from TCO, and they flagged a big $1 billion loan repayment coming from TCO in the third quarter.
Okay, shifting back to the U.S. California's refining market came up, especially with competitors closing plants. What was Chevron's take?
They acknowledged the closures, yeah. Blamed it pretty squarely on California's challenging policies and regulations.
But are they planning to close anything themselves?
They didn't announce any changes. They basically said they feel they have a strong position there with their 2 refineries and integrated system, but they definitely voiced concerns about the state's policy direction.
Right. Always a hot topic. Capital allocation, dividends, buybacks. What's the latest thinking?
No real change in priorities, they said. It's still, number 1, grow the dividend. Number 2, invest wisely in the business. 3, keep a strong balance sheet. And 4, return any leftover cash via buybacks.
And they still have that big buyback range, $10 to $20 billion a year.
Yep, that range is still the target, but they emphasized it depends on commodity prices and their outlook. Right now, they said the pace is in the lower part of that range because of current market conditions.
So what does that mean for this quarter, Q2?
They guided for Q2 share repurchases to be between $2.5 billion and $3 billion.
Okay. And they mentioned debt levels, too.
Yeah, they reiterated their goal to move that net debt ratio towards the 20% to 25% range, but that's a through-the-cycle target, over the longer term.
Got it. Let's talk big projects. Gulf of Mexico seems busy.
Very busy. Ballymore achieved first oil in April. They said it was on time, on budget.
Nice. How much production are they expecting from Ballymore?
aiming for 75,000 barrels a day from the first 3 wells. 2 are online now and ramping up. The third comes later this year. Apparently, they're really prolific wells, very high temperature too, which is interesting.
And what about Anchor, their other big Gulf project?
Anchor has 2 wells online, performing well. 2 more wells expected this year, and the rest in 2026 and 2027.
Oh, the Gulf is a definite growth area then.
It's like it. They expect their total Gulf of Mexico production to hit 300,000 barrels of oil equivalent per day in 2026, thanks to these new projects starting up.
Okay, back on shore to the Permian. Still the powerhouse.
Still crucial, yeah. Management sounded really positive about performance in the Delaware Basin part of the Permian in 2024, especially something called the Second Bone Spring in New Mexico.
And they expect that to continue.
Pretty much. They expect similar well performance, similar type curves, they call them, in 2025. Most of the drilling, about 85%, will be in the Delaware Basin again.
What about the mix of oil versus gas?
They see the oil cut staying fairly steady, around 43 to 45% through the end of the decade. They did mention more wells coming online in New Mexico this year, and those tend to be bigger wells, potentially more oil-rich initially.
Are their partners in the Permian pulling back at all, with maybe lower prices?
Apparently not. They said they haven't seen any significant pullback from their joint venture partners, who are mostly, large, well-capitalized companies operating in the core areas.
Okay. Let's go international again. Eastern Mediterranean, Cyprus. Any news there?
Yeah, they've agreed on a field development plan for the Aphrodite gas project there.
Aphrodite, right. What's the plan?
It involves a floating production unit processing around 800 million cubic feet of gas per day. The idea is to then pipe that gas to Egypt.
Is it a definite go?
Not yet. They're in what's called pre-FEED, basically early engineering and design. They need to make sure the economics work and it delivers competitive returns before they make a final investment decision, or FID.
Okay. How about their chemicals business, CPChem? That sector's been tough lately.
Yeah, they acknowledge the chemical cycle is currently in a trough, mostly because a lot of new industry capacity came online recently.
But they're still positive long term.
They are. They see the long-term fundamentals as attractive and expect things to return to sort of mid-cycle conditions in a few years.
Right.
They view CPChem itself as a very strong, low-cost operator.
And CPChem has growth projects too, right?
Yep, big ones in Qatar and Texas. Those are apparently on track for late 2026 or early 2027 startup.
And didn't Chevron say they might want to buy the rest of CPChem?
They did express interest, yeah. Said they'd be interested in acquiring the other 50% from Phillips 66 if they could get it at a, quote, reasonable value. They see strategic sense in owning it all.
Okay, this is interesting. The Power Solutions venture for AI data centers. What's the latest on that?
Sounds like it's moving forward. They reported strong interest from potential customers needing huge amounts of power, like gigawatt scale.
So they're actually building power plants.
They're planning to. They're narrowing down potential sites now and moving towards detailed engineering and construction options. The goal is to make a final investment decision before the end of this year.
Is cost an issue there? Building big infrastructure projects?
They're watching costs, for sure. They said they've locked in pricing on the main turbines, which helps.
Yeah.
But the key thing, they stressed, is that these projects have to generate competitive returns compared to their other investment options.
Makes sense. With oil prices always up and down, how do they talk about resilience? If prices were to fall significantly.
They pointed to a few things. One, their portfolio has more low decline assets now, like LNG and the TCO expansion, which helped stabilize production.
Okay.
2, their capital budget is flexible. They already cut it by $1 billion for this year. A lot of their spending is on short-cycle shale or projects nearly finished, so they can cut back more if needed, like they did back in 2020.
And the cost structure.
They feel their upstream business has a very low break-in price. And they also mentioned that deep water development costs, like in the Gulf, have actually become quite competitive recently.
One last thing from the call tariffs. Do they seem worried about potential trade issues impacting costs?
Not overly worried, it seemed. They think their direct exposure is pretty limited, partly because energy itself has mostly been exempt from tariff.
Where they do spend money?
Most of their third-party spend is on services, not goods. And within the U.S., they source a lot domestically anyway. Their current estimate is maybe a 1% impact on the cost of a shale. Well, potentially.
So monitoring it, but not a huge concern right now.
Basically, yeah. Monitoring and trying to mitigate, but doesn't sound like a major headwind at the moment. Oh, and they also gave an update on the Pasadena refinery expansion.
Right, the downstream project. Is that done?
Yep. Project complete, online, and ramping up. They hit stable operations, processing 110,000 barrels per day of crude in Q1. That'll help them run more of their own Permian oil and supply more products to the Gulf Coast. Create some nice synergies with their other big refinery in Pascagoula, too.
Okay, great. So let's try and wrap this up. It sounds like, overall, a quarter where they executed well operationally in places like TCO and the Gulf. They kept spending disciplined and returned a good chunk of cash to you, the shareholder.
Definitely. But the bottom line, earnings were clearly down compared to last year, hit by, market conditions and those specific items like legal reserves and taxes.
Yeah, and the earnings call really seemed to emphasize management's confidence, right?
Yeah.
Confidence in future cash flow from these new projects starting up, confidence in their cost control, and confidence they can handle lower oil prices if need be.
Exactly. That resilience message came through pretty strongly.
All right, so here's something for you, the listener, to think about. Chevron's clearly focused on its core oil and gas business, driving efficiency and starting up big projects. But they're also dipping their toes into new areas, like these power solutions for AI data centers. Considering that dual focus, how do you think Chevron's strategy might evolve over the next, say, 5 or 10 years, especially as the whole energy landscape keeps shifting? What could the long-term implications be, both for investors and maybe for the wider energy market? Something to mull over.